Okay, so I want to take a look at this problem relating to a note receivable. You aren't given a lot of information. What you're asked to do is determine the interest on the following notes, and we're given 4 scenarios of different notes receivable. Now, there's a couple components to this problem that I want to cover in this tutorial. The first one is we want to understand how to read this language. Okay, well, we'll get to that in a moment. But more than that, let's understand what exactly a note is. That's kind of the larger conceptual premise here. It's important that you understand a note in general in terms of what it is and how it differs from an account receivable. So let's imagine that we are a company and we sell equipment. We sell it to a customer who promises to pay, meaning provide cash, okay, within 90 days. And this promise to pay is subject to a 6% note receivable. The cost of the equipment is $2,000. Okay, and I have a diagram here below. Equipment is sold. We are selling it to the customer for $2,000. The customer, rather than giving us $2,000 immediately in exchange for the equipment, says, hey, I'll pay you in 90 days, and I'll pay you the $2,000 plus some interest. And the interest will be subject to this 6% rate, annual rate. Okay. This is an example of how you could put this transaction into the context of a note receivable. A note receivable is similar to an account receivable in that it's an asset, and it is a promise to that it's a promise that we are to receive cash at a later point in time. So it acts very much like an account receivable. A note receivable is an actual document, okay, and I have kind of just a little visual here. It's an actual document that has a face amount. In this case, it would be $2,000. An interest rate would be 6%, and then a term, a fraction of the year. In this case, it would be 90 days. How do we compute the actual dollar amount of interest? Now, down here is sort of the formula that we can look at. We want to take the face amount, and this is the face amount, the $2,000, times the stated percentage interest rate. And then we want to take the fraction of the year that the interest rate applies to. Okay? So let me just write down some of these terms, and then we'll look at the fraction of the year in more detail in a moment. So we're going to look at $2,000 times 6%. If you're using a calculator, you can just input this as 0.06, or you can use the percentage sign. And then we want to look at fraction of the year. Now let's look at what that means. We know that the note applies to only 90 days of the year. A key concept here is that this 6% is an annual percentage rate, meaning this rate applies to the full year. So let's just kind of visualize this. So 6% is the amount that applies to the full year. If the note is specific to only 90 days, okay, then we want a way of apportioning this interest rate, or kind of applying a fraction of the rate to this 90-day period. Now, I want to make one point here. What we're doing here on this slide here is we are breaking up a year into days or months, depending on the time frame that was given to us in the facts. So you can see here in this problem where we have days here. Part B gives us months. Part C gives us days. Part D gives us months. In each case, we are simply breaking up a year. We're apportioning a portion of the time of the year. I will note, we use 360 days, not 365. This is an accounting convention, and it's because 12 divides evenly into 360. So we are kind of taking 360 and sort of assuming that each month is 30 days. Just know that that is a convention, and we're going to use 360 and not 365. So if we want to find out the percentage, the 6% that applies to only 90 days out of 360, what we do is we say 90 divided by 360. So our math here is $2,000 times 6% times 90 divided by 360. That gives us $30 of interest. Okay? That's how we would interpret this problem. The probably the trickiest or the newest piece of this is this splitting up of the year, and just understanding that this annual rate needs to be apportioned, and it needs to be apportioned based on either a 360-day or 12-month year. Okay? Let's take a look at how we would do it for the 5 months. We're going to work the same kind of process here. This is A. Let's look at B. $900 times 9%. Oh, sorry about that. Let me fix that. Make that a little neater. Times 9%. And now what we're going to do is, instead of days, we don't have 360. Instead, we have 12 months, and we're looking at about 5 months, which is about this period. So this is a 9% rate that applies to the full year. So we want to take 5 out of the 12 months, 5 months. So we're going to do 5 divided by 12. Okay? If we do that math, we have 900 times 9%, not 6%, 9%, times 5 divided by 12. That will give us $34 of interest. If you're interested in seeing what this would look like in a spreadsheet format, I have it here. I have a Chapter 9 spreadsheet. It just lays out this calculation going from principal, interest rate, days and year, and then just showing how this calculation would look in a spreadsheet. So you're welcome to look at that as well, and even use this calculator if you would like for parts C and D. I would encourage you use paper and pen. This problem, what it asks you to do is not just do the math, but read the facts. And that's part of the skill here, is reading the facts and being able to interpret them to then do the resulting math below.